All right, all right. Well, everybody, it is going to be a-okay. Regardless of the market, you guys are rock stars and you are going to power through. Thank you for joining me for our official Q3 market report. Thank you, everybody, for being on. I think Gordon told me we're up to 187 registrants. We're going to have a lot of our Rock and Keller Williams agents, some very awesome guests from other companies joining us from around the state. And a lot of work goes into preparing for this. So thank you, everybody. My name is Jonny Christensen. If I haven't met you personally, I am the regional director for Keller Williams for the state of Utah. This is our third time doing this. And there has never been a better time to make sure we're paying attention to the market. You guys agree? Thumbs up. Yep. I want to introduce a couple of my co-hosts. Jordan, the man Larsen there. He has fulfilled many leadership roles for us for Keller Williams across the state. But as of late, he is a Rockin' Maps coach. So he is a full-time productivity rock star. So he is all about coaching people up. And then our other very special guest, who actually is the smartest person on the call, but Gordon Payne. He is our regional operations manager. He is our local economist, spends about 100 hours a week putting these things together. So thank you, Gordon. Gordon will chime in here and there. So Jordan will be monitoring the chat. He'll be jumping in and out with me, but I'll be your tour guide of what the heck the market has been doing the last 3 months. So Gordon is officially up to, I think we're somewhere around 30, 40 different sources that we have to pull all the data from. We continue to expand this. Gordon sends me an email every other day with a new index or some sort of data to track. So we've got a lot of great stuff for you. So thank you for being on the call. But before I get in, a couple housekeeping items, I want to jump in. Jordan, any other introduction you wanted to do?
No, I think that's great.
Are you excited? Stats are one of the funnest things you could do on a Wednesday morning, right, Jen Jorgensen? So a couple things real quick. Our hearts go out to our Salt Lake Keller Williams Market Center. I know you had a neighbor really close, big apartment building burned down. Officially, our Salt Lake office is currently closed. Hopefully we don't have too much smoke damage. We had a little bit of distance from it, but I know that whole area is on lockdown, so our hearts go out to you. And we have plenty of offices around. If you need to print something, use conference rooms, come join us. We happily will support you. And then real quick, I wanted to make sure everybody knows, I know Gordon already sent this out to all the registrants, but real quick, wanted to show you where you find this market report that I'll be navigating through. So kwutah.com is our region website for Keller Williams, Utah. If you go to kwutah.com, you click resources. There's going to be a few of these buttons that pop up. You are an agent, most likely. Agent resources will link to our Google Drive folder that where we store these at. Quarterly market reports, you can click on that. And then 2022 will have the different quarter market reports. So clearly we already are over 3 weeks into the fourth quarter. But again, we compile from so many data sources and they definitely take their time on putting out some of their data. We try to collect it as fast as we can, but usually every day after the quarter ends, we're updating some of the sources to prepare this for you. And again, the last 3 months has probably been the wildest ride on a lot of these data points since we start tracking a lot of these the last several years, no doubt. And then one bit of caution. So I think the smarter I've gotten at stats and the more I've paid attention to market data, the less I've been wanting to project anything. Clearly, the smartest people hate looking forward because you can always be right, you can always be wrong. We will go over a handful of projections, but again, just be cautious on how you look. No doubt us as business people, we're trying to see where we're going and what storm or whatnot we're trying to head into. But you just have to be careful that you're not throwing out a bunch of stats that may not come to fruition, because whatever you say, 50% chance you're right, 50% chance you're wrong. So let's jump into it. Any comments or questions before we jump in? Anything you want to kick off, Jordan or Gordon, before we jump into some data? Okay. All right, so let's just do a quick summary. Here's our summary page. So you can look at the last 3 months, month over month on the month comparison. So if you see new listings in July 2021, we took 6,310. July of 2022, we took 6,082. So that was just a 3.6% drop from month over month. So you can kind of see the trends over the last several months. And then clearly the big number you want to pay attention to is year to date. So no doubt you felt this. Number of listings come on in the market is slightly up across the state, 3.2%. But actually it's thinning out. We used to be a little higher than that several months ago. So it's actually there is a chance we could end up just at the same amount of listings that came on the market 2022 that did in 2021. That was one of the numbers that surprised me. You guys have felt this is just the number of homes selling and going under contract, there's less. So we're down 14% in closed sales year to date. We're down 19% on under contracts. This is statewide. No doubt you felt days on market tickle up a little bit, but no doubt that still seems low. I still think that's going to go a little higher. Some of our saving grace the last couple years, no doubt, has just been that price has been shooting up, but is also the creation of some of the problems and challenges we have. But we're still sitting at year to date up 18.4% on median sales price across the state. Percent of original list price a year ago, you could pick a list price and it would sell for more than that almost every time. But we're right at now almost on average, what you list it for is what you sell for it. But I know a lot of you, even just October's numbers, which we don't have that data, you're seeing price reductions and price changes and builders throwing money at and concessions. Like no doubt we're going to see that go down. Housing affordability is down, less affordable, right? Rates killed us. The price has been going up, which has hurt affordability the last several years, but with rates and the speed at which rates changed, we've gone backwards year to date a third. Affordability is down 1/3 compared to where we were last year, primarily because of rates. And then inventory, man, we had so few listings on for so long, and we blinked and we had 10,000 listings on the MLS for sale at any time. We're already above that, but no doubt homes for sale year to date, we've had 67,000 homes come on the market, and the month supply of inventory. So no doubt supply is going up, which I think at the end of the day for us is positive. So again, if you haven't joined us in the past couple quarters, we go through the nation and then we go through Utah. We've done as close as we can to find the most comparable, accurate sources of data to show you what's going on in the general macroeconomics economy of the United States of America. And then we compare most of those categories to what locally is going on with the state of Utah. And again, no doubt your counties, your cities can be slightly different than the state. So I always challenge and encourage you to even dive a little bit deeper to just what your local market is doing in comparison with the state and the nation. Okay. And Jordan, go ahead and just interrupt me if you need to on any of the chats, but we'll go through as much as we can. We have more slides and more data than we're going to be able to hit in a 90-minute period, but that's why I wanted to show you where the slides were on kwutah.com, just so you can go back and get those, use them how you want, and then have your own little masterminds. I think I would challenge you to everybody sit down with a group of people and reflect and talk about what are you going to do about this now that we presented this data. So 2021, 6.1 million homes sold in the country. The projection was that we'd end up this year at about a 5.1 million homes sold in the country. The first 6 months of this year was great. Last 6 months, not as awesome, but that's where the story really gets told on the monthly, the month to month. This is the last 12 months rolling homes sold across the country. So look at the purple in January. That was the last highest number after COVID we saw, because we saw October, we saw December of 2020 hit it. But January 2021, the last 12 months before that, we were at 6.7 million homes sold across the country. At the end of September, we ended up as low as 4.7 million homes sold. So from January of 2021, 18 months later, we dropped 2 million homes closed in the country. Have you felt that? No doubt, right? And I think overall, I think just so you guys know my opinion, which you have to filter, but I do think it's going to get a little bit worse before it gets better. But I think we felt quite a bit of the pain of what we're going to be in this new market already. So hopefully this is kind of a little bit of new norm and we'll figure out how to adapt to it. Utah. Now Utah, you see 2020, we peaked at 60,000 homes sold. COVID month of March, we basically stopped selling houses, but we rebounded so dang quickly. But that was the best year on record for the state of Utah. Last year, we dropped 5,000 homes sold, so 55,000 last year. Our projections that our best guess is about 45,000 homes sold across the state of Utah in 2022. And where we get some of that projection from is here's the month to month for the state of Utah. So 2022, just September, we sold 3,736 homes. August, 3,983. But you add up all those blue numbers, and even if we projected around 3,500 homes sold in October, November, and December each month, that would put us at 45,000 homes sold this year. Okay, but you can kind of see where we're trending with those other year comparisons. So no doubt we felt that drop in just available sides out there for our agent base. And again, one of the bigger challenges that we've talked about is realtor population is at an all-time high. We're at about 1.7 million realtors. So our average sides per agent right now across the country is actually definitely one of the harder stats. And so that's something to watch is we're going to see a little bit of fallout on membership association over the next 12 months, no doubt. But prices, who owns real estate? Who's owned real estate the last several years? It's been great to own real estate. We all think we're super smart when the market's going up, no doubt. But 2021, the median home price across the country was $347,000. Our projection for the country was that we were going to end up somewhere around the $378,000 number. And again, when you talk about a whole year, you have to blend the whole year's numbers in home sales, all that sort of stuff. So the fact that we're at 4.7 million homes sold already the last 12 months, but we're projecting 5.1, that's because we just started out the first half of 2022 so well that the drop is way more significant the last 6 months of the year to actually balance out at that 5.1. So same thing on price. We've already seen a trend down in pricing, but because we started the year so strong, it still ends up being overall higher than 2021. But here's a month-to-month basis, which shows that trend. So the nation, the country, peaked in June. So we were at 416,000 median sales price across the United States. Last month, we already dipped down to 385,000. And no doubt, I think we're going to see declines the rest of the year across the country. But Gordon's overlaid the actual interest rates. You can see how the interest rate, average mortgage interest rate last month was 6.11%. And how that kind of overlays to that pricing. The higher the interest rate goes, no doubt that's probably going to put pressure on pricing downward. U.S. median home payment. So this is the median home payment, principal and interest. If you put 20% down on the median purchase price of a home across the country, 20% down, look how big and fast that payment shot up. So 2021, we averaged, because rates were averaged 3%, average mortgage payment was $1,170. So that's just P&I. Look how fast that shot up. So crazy. 1,867 at the end of September, but the rate literally doubled from that graph to that next one. And Utah, man, we've been famous the last several years. We've been in a lot of media outlets on our positive appreciation. You know, the Boise market, you see Phoenix, you've seen Vegas, Austin, Texas. We've typically been in those top three appreciatory, is appreciatory a word, Jordan? I don't know, but appreciative market the last several years. But then look at Utah. Here's home prices by month in Utah. We actually peaked a couple months earlier than the nation. So we peaked April at 535 median sales price, which we officially outpaced the state. The United States, typically I'm so used to Utah's average price or median price being lower than the nation, but no doubt we've outpaced that with how cool the state of Utah is. But we've been on a downward trend for 6 months. So we ended 490 in September. Raise your hand if you've taken a price reduction on a listing the last 60 days. No doubt that is part of this is just sellers. Who's the first person in the marketplace to know a shift has hit or a shift is coming? It's always buyers, right? They're feet to the ground. They're looking at prices. They're getting their mortgage payments calculated, pre-approvals, offers. Buyers always know a market shift before anybody else. Who's the second group? It's agents, because the buyers are telling their agents that things are less or more affordable or whatever way the market's moving. Who's always the last to know is your sellers. They're always last to catch up, whether that's they're a little trying to hold on to their equity, but no doubt I think a lot of sellers have woken up around the state and starting to be very realistic and wanting to throw some of their equity at either buying rates down or concessions or lowering price, which is really what sped up that decline on that. So Here's your Utah median home payment in the across the state of Utah, $2,378 is the average median. I mean, the median home payment of the median purchase price with 20% down at that 6.1% interest rate. We went in a 12-month period. Basically, we added what, $800 to a monthly payment, and no doubt your buyers, your renters, the people on the fence or getting off the fence have felt that, which is really what's driven the number of closing down. So. And here's a comparison. I appreciate you doing this, Gordon, but here is median home price comparison. The last basically 20 years, look how tight we hugged Utah and the United States, depending on the month. You know, somewhere around 2007 is when Utah actually started outpacing the United States on median price. I started my career in 2007 right there and actually rode the market down until 2011. We ended at the bottom of 174,000 median price in Utah. But look at the gap that we've created between the United States median and the Utah median, which is why we've been in the top 3 of appreciative markets out there, which is great. But one of the things, Jordan, you and I were talking about this yesterday. One of the things I'm hearing a lot from our agents that I think is an outdated statement is that Utah is insulated from some of the negative market conditions that go on in the United States. Have you heard that, Jordan?
Yeah, I think for a long time, we've talked about how in the shift in 2008, 2009, Utah, as you can see in this graph, we just experienced less of a depreciation than a lot of the other states and places in the United States. We've now outpaced that. We are far above the median average for home prices. So we're losing that insulation of the ability to say that our market's not going to retract as much as other places in the country.
Yeah, and I think bottom line is just we went up faster and higher, so we potentially are less and less insulated than we have been in the past, right? Like our stable economy has been one of our leading powerhouses as a state, no doubt. And even the last recession or any market shift, I always felt like the time that we could watch other markets like Vegas, you know, California, Phoenix, you know, Austin, it felt like to me that it always gave us a little bit more time to prepare to copy whatever that was happening in the market. But I actually think Utah now is actually more on the forefront of the ship just because we appreciate it so much. So I think we're more likely to move faster than other markets, right? Here's home prices and annual appreciation. Here is just a year by year bar graph, which makes it a little bit easier to kind of see what's gone on the last, 30 years as a marketplace. From 1990 almost to 2001-ish, we were pretty dang stable on that appreciation. Normally that 3-4% appreciation line, economists always say is very sustainable. We went into an overbuilding phase. We went into an over appreciation phase. Obviously, you guys know everything about the mortgage market and all that sort of stuff, which really created the criteria for a big Great Recession. We recovered from that pretty quickly, 12, 13, 14. But again, 2020, 2021, 2022, massive appreciation. That's just around the country. That's the projection still for 2022 that NAR put out. They continue to lower that projection. I've heard numbers at 5, 6, 4% appreciation on average because we appreciated the first half. We're depreciating the last half. So those are going to have to balance out somewhere. You guys might not like this, but I think there's a high probability we could get back down with how fast prices are going down right now to a 0% appreciation overall the whole year of 2022. So the decline is going to wipe out the increase that we had at the first half of the year. But again, here's Utah's appreciation on a bar graph form. Again, we went down less in the last recession because we didn't go up as much. But even just 2021, if you owned anything in 2021, it was great to own stuff. 25.7% annual appreciation. We're still projected 11, but that every month that goes by, every day, every week, that kind of keeps going down a little bit faster. And next year, Gordon, let's talk about next year. Again, we talked about the combating the feedback of the insulation of Utah market. At this point, this is just purely my opinion. Everything that I'm seeing in the market report, I read a lot of economist reports. I don't really know how it's possible to not depreciate a little bit next year. Like if you think that we're going to be break even or appreciate a little, I think I've started moving into that's hopeful or wishful thinking with some of the corrections that we need to get corrected on that. And we'll talk about mortgage rates coming up. Does anybody have an opinion on that? Jordan, Gordon, anybody?
No, I think you're absolutely right. As we're seeing a retraction in the market and affordability continue to get hit, home prices will come down slightly. We will see some depreciation.
Yeah, yeah. Okay, here's the U.S. inventory annual. Again, when you're looking at an annual number, it doesn't look like it's moved very much. Year to date, we're still sitting around that 2.4 months of inventory. You see that line drawn at the 6 months. Again, if you don't know, 6 months is considered that balanced market. Anything above that's a buyer's market. Anything below that is a seller's market. And then here is the month to month, which actually shows the increase a little bit more realistically. We started the year at 1.6 months of inventory across the country. We ended September at 3.1 months. So in the last 9 months across the country, we've doubled our inventory out there, which again, we've outpaced this, no doubt, in the state of Utah. U.S. pending home sales index. You're going to see a lot of indexes or indexee that basically is going to have some sort of reasonable or normal line drawn at 100. So if it's above 100, that usually means that most likely it's a better stat. If it falls below 100 index, that usually means it's either contracting, shrinking, or it's a little worse than a normal field type of market. So this is just overall U.S. pending home sale index. We officially, on average now, with even the first 6 months, we've officially shrunk into a contracting. Again, if you look at the month to month, it shrunk even more. We ended August. The September number's not out on this data source yet, but we ended August at 88.4, and I don't see how September wouldn't be a little bit lower than that on just our pendings. But here is inventory, another look at that. This is U.S. new single family housing units completed in the thousands. Normally that solid number, there's debate anywhere from 1 million to 1.2 million homes have to be built every single year for us to be considered keeping up with the demand of new housing needed. Which again, that early 2000s, we know we got into an overbuilding phase. We were doing, close to that 2 million number. So when the recession hit, the percent of, homes out there that were vacant or foreclosed or whatever, that was a big risk for us going into that. The fact that we're going into this recession very underbuilt. The most common projections I see that we're anywhere realistically from 4 to 5 million homes underbuilt still in this country. So when homes become unaffordable, what do people do? That's where you're seeing combined households. You're seeing, people move back in with family or parents or whatever, but doesn't erase the fact that that pent up demand is still a little bit of a ticking time bomb for us. So part of my optimism coming out of this, again, a lot of times a recession, you need to survive for a little bit, prepare yourself, and just get ready to capitalize on the opportunities. I don't know when it will be, but as soon as we get on the other side of this, get some of these economic challenges figured out, I just feel like the wave that could be coming will be bigger than the wave coming out of the last great recession. So you have to be working hard or preparing yourself for that wave of an explosion of buyers and whatnot coming back into that market. Here is on a month-to-month basis over the last 12 months. So September, we're pretty much at a peak. We built 1,049,000 homes built in the country the last 12 months. And then U.S. showing index. I know some of you are watching showing data, but again, we have a lot of the lag measures, closings, prices, that type of thing. We've tried to exhaust sources of the prediction numbers, whether it's mortgage applications, showing indexes, listings on the market, under contracts or whatever. The more sources we're trying to find that actually tell us what's going to happen very realistically the next, 90 days, maybe 6 months away. But here is a U.S. showing index. A higher number means an average home receives more buyers visits in a given month. All index values are scales relative to the initial index at 100 again. So you can see basically for the last 6-7 months, we've been under that 100 index. So we're down 17% on that index. You can see right after, kind of that recovery of COVID, just look at that year over year percent change, specifically in March, because in March of COVID, it felt like Armageddon and we were just stopping, but we rebounded so quickly within 30 days. But that month over month just gave us an outrageous high showing index number. But over the showing index average, you can see just how much activity was going on, right? Which again is what caused a lot of our agents to be burnt out. So a lot of the things we're solving right now, I know there's different challenges, but it also is solving some of the previous challenges that we had. Here is the Utah numbers. Let's go through some of that same data with the Utah lens on it. Annual months of inventory, again, 6 months, considering that balanced, we are averaged 1.8 months of inventory year to date. Last year, sub 1, which is crazy, but we were at 0.9 months of inventory, multiple offers. You had 13 seconds when a home came on the market to get pre-approved and write an offer on it and give up every condition possible to try to go under contract. I heard a stat the other day. What did I tell you, Gordon? I think it's like 20 or 25% of people that bought in that time period that have been surveyed absolutely regret their purchase because of the fact of the speed and the waiving of conditions and the over list price payments that they had to pay. Now that they've had a few months kind of before even the recession hit, a lot of regret started creeping in, which is the challenge in a very extreme seller's market. In a buyer's market, they have so many options, but that balance is what's really healthy between the buyer and seller's perspectives. Here is Utah months of inventory, very similar to the growth we've seen in that on the nation, but we're at 3.1 months of inventory at the end of September. And again, if we had live data, at least the last 26 days of October, it's probably worse, right? Utah new listings, 2020, 67,000 listings came on the market. 2021, 61,000 came on the market. We were actually up most of the first half of 2022, up about 10%, the number of listings coming on the market. So we were pacing to hit that 2020 number again, but now we're down to that 3.2 increase only. And it's slowly gotten a little bit slower, especially with us wandering into a little bit of the holidays seasonality a little bit. That's why it is possible that we could have a very similar 0% increase or decrease compared to last year on new listings coming on the market. Which again, here is the month to month. We had 5,000 homes sold, come on the market, new listings come on the market. But again, Jordan, the real challenge compared to last year, 61,000, even if we hit 61,000 again by the end of this year, what percent of those listings sold last year out of the 61,000? Wasn't it 62,000 of them sold? Just kidding. It almost felt like every one of them sold. But even if we hit that same number, the percent that actually go on to sell is where that other gap's been created, right?
Yeah, you've got that gap of pricing the home correctly to sell and a lack of buyer demand.
Yeah. In the Great Recession, when I got on the market, we got as low as 35% of all listings that came on the market ended up selling. Where we're coming out of a market that it felt like almost 99, maybe 100% of listings sell. If it actually got back to that worst case scenario, that means 2/3 of listings you take don't sell. I don't think it'll be that bad, but again, you have to watch that number because taking overpriced listings, not being drastically honest and direct with our clients so they have the right information to make the best decisions. It's just time to up our skill set. It is not just sign the paper and it's a paycheck. You've got to be very talented. You've got to be very skilled. And again, this is where, the people not committed to being the best get exposed in a market like this. Even coming out of a market like we came out of, every business model works. When we go back into a market similar to this, it exposes bad models. So you got to make sure that you're going back to training, you're going back to the model, and you're being very smart about the decisions you make in your business. But here is that percent of new listings sold. This is on a month-to-month basis. That's why you get some of these 160s. So some months we will just sell more listings that actually came on that market in a month period of time. But that's where you normally want to kind of see the trend going on right now. So again, we're probably pacing somewhere around that 25% of listings on the market don't end up selling. So 1/4 of listings are not selling right now. And then here's even the current, any given moment, current homes for sale. Gordon, I don't know the exact number, but somewhere around March was our bottom. And we were somewhere around that 3,000. And this is outside of Utah real estate. Again, we pull in all data. A lot of this comes from UAR and combining the MLSs. So if you've been just checking active listings on the market, only on the WFR, the Utah real estate, you're missing Park City and St. George. And there's still a high percentage of those listings in those markets that still end up on Utah real estate. But that's why those numbers might not be exactly comparable to what you've been pulling up. But again, we ended September at 12,000 listings on the market, which when you compare that to 3,000, that's crazy, right?
This includes all the MLSs.
Yep. Includes Park City, St. George, and the Utah real estate. But the fast and the speed of which that grew has been very apparent. You guys have been posting all sorts of stats and social media posts about it. But just to put this in perspective, I'm glad you went back this far, Gordon, but look at the peak. This is 2008. This is young Jonny wearing a shirt and tie, so people didn't think I was young and didn't want to sell with me, but 33,000 homes on the market any moment. So for us to truly get back to that Great Recession, look at the number of homes that have to be on the market at that time, which is very hard to think that we'll ever get back to that. Utah homes for sale at any given month. Again, we ended at 12,288 in September, but just even in March, a 6-month swing, we added almost 9,000 homes on the market at any given moment, which is still, you looked at that month of inventory, that's still only about 3.5 months of inventory. Again, it's still not even close to that 6-month mark, but we're trending towards that every month that goes by. Here's just a year-over-year comparison of current inventory. When the number of active listings on the market, you just see even 2022 on average any day throughout the year compared to 2021, we're up 57.4%, which is a lot healthier of a number. Going from 2020 to 2021, going down that fast, that far, down 52% compared to 2020, which was already a decrease of a significant portion. That's what created those challenges that we're in. So Gordon, this is pending sales at any moment. 2021, we had 56,000 pending sales. And again, we're down from 2021, but here's your month-to-month pending sales. In September, we only had 2,859 pending sales. So far, our worst pending or under contract month in the last 3 years, no doubt. Days on market, here's the United States days on market, still really low, which, all the affordability issues, closings, all that sort of thing play into that. But still 19 days on market across the United States. And then again, average days on market, 2022 still averaging about 27 days on market. But here's your month to month, we've doubled in 3 months. We went from 21 in June, now up to 40 days. Now up to 40 days on the market. Mortgage rates. Do we have any lenders on the call? Let's talk about the mortgage market for a second. And this is where Gordon and I are going to nerd out for a second. But again, historical average, I know you guys have heard this a million times. The last 50 years, we've averaged 7.81% interest rates. The historical average the last 30 years, with how low they've been the last decade, averages out at 5.97. Last year, ended the year on average at 2.96. Does anybody have a mortgage rate in the twos? Here is your annual average 30-year fixed. 2022, again, we started the first half very low mortgage rates. I think I heard last week the average rate crept up in the high 6s, no doubt, but averaged out still somewhere around that 5%. Projections next year. So I was, I know a few have asked me, I was in some executive meetings down in Texas last week. Gary Keller was up on stage talking just a little bit about some of his updated research department projections. Right now, the last 12 months in the country, we were at 4.7 million homes sold the last 12 months. We do think it's going to get lower. Our projection, our best educated guess is next year, if everything kind of keeps going the way it is going with a lot of the economic factors playing into it, the projection that I heard from the stage from our company was we could get as low as 4 to 4.2 million homes sold next year, which again, when we go from 6.7 down to 4.7, we've already dropped 2 million, which we have felt the biggest chunk of the pain already in that drop. I know a lot of you are adapting quickly, but again, the bottom we think potentially could be another 500,000-ish homes. But rates is the other projection that we no doubt don't feel like is going to get drastically better sooner than later. But I've heard that rates, because if we're already close and knocking the door at 7, the rates that we heard potentially could be 8% on average next year is the guess that I'm putting out. But again, quoting projections of rates could get you in trouble with your buyer. So be very careful about that. Here is the monthly mortgage rates specifically across the country. Last month, we ended up at 6.11. I think we've trickled up a little bit since then. But again, January 2021 was all-time lows, averaged 2.68%. How many of your buyers in your database would buy right now if they could go get that 2.68% interest rate? That would solve things pretty quickly. But I appreciate this because there's no doubt differences in rates of loan products. So Gordon has created this for us, but here is the 30-year fix, which is orange. Rates over the last, several dates that we pulled that. Here is the 15-year fix in green, and here is a 5-1-year ARM average rate. Which again, that 5-1 ARM rate, I know a lot of you have looked into those products, but those tend to be a little bit lower because there's some adjustable risk in that. But 6.9 was pulled 6 days ago, 6.9, which is where those high sixes have came in the last several weeks, 6.2% on a 15-year fixed rate, and then a 5-1 ARM dropped a little actually in a week, but 5.7%, 5.7%. Jordan, Gordon, did you have any comments on kind of what rates have been doing the last several months? Nope. Okay. So again, the Fed rate, everybody keeps talking about what the Fed Reserve does. They keep bumping it up, basis points, yada, yada. November, a lot of the reports are saying that the Fed is projected to raise the Fed base rate again, 75 basis points. December, is where there's a little gray area. I've heard anywhere from 25 to 75 basis points. So much of the stock market and the mortgage market are trying to bake in the immediate future basis points and stuff. They're trying to predict, and bring that into their pricing right now. The Fed has been known to say the last couple of press conferences that they see the raising of rates, no doubt slowing down, but 2024 could potentially see the first decrease, but they're very cautious about saying the word decrease. But I asked Gordon to do this, which I appreciate you doing this, but I wanted to see what is the Fed rate? What is the Fed rate at? I've Googled a bunch of times, but actually what has the Fed rate been doing? And then what is the mortgage rate? So this is the 30-year fixed rate mortgage in orange or yellow, and purple is the Fed rate. So look at the, because it isn't always directly impacted, and it's also somewhat directly impacted. But again, you look at 2009, basically until the early 2016, it was virtually at 0%. And I know a lot of you know that, but the Fed, because once they hit 0%, they really removed part of their few levers that they have to maneuver the economy when they have no options. So part of their, not just inflation and where we're at, they want to get the rate raised a little bit just so they have options of going down or up if they have to, right? But look at rates. It's pretty dang immediate, but even 2004, look how big that jumped up, but how little it impacted rates. But again, even when it was down at 1%, we were still floating around those 5 or 6%. So there was just a giant gap between that. 2007, right when that recession was kind of getting started, that gap between those two is pretty low. But you just see when the Fed goes up or Fed goes down, we're kind of following it pretty closely the last 2 years. So the Fed rate at the end of September is sitting at like 2.56, which put us, maybe 3.5% above that for an average mortgage rate.
Well, and if you look back to the early 2000s, we weren't buying the paper. The Fed wasn't buying the loans. So in the next couple of slides, you're going to see the difference in those rates down to below 1% for the Fed funds and where our actual interest rates ended up.
Yeah, this is what you're talking about. And so you and I have learned a lot. You've taught me some on this. I even tried to peer pressure Gordon into going back to school so we could take some macroeconomics classes. Can you picture me and Gordon with our backpacks on walking down the hall? But anyways, a couple of the levers they have is the Fed funds rate, which we track that. That's very easy to kind of see. But one of the other big metrics that me and Gordon have talked about at length the last several weeks is them buying mortgage-backed securities, right? So part of that is across the country right now, there's on average around $10 trillion in mortgages, okay? And again, when a company issues a mortgage, when Billy Bob goes and gets a mortgage, you know, they turn in all their financials, that bank or institution, whatever, they give them that money, right? The vast majority of banks then sell it off to Fannie or Freddie. But again, what happens is all those mortgage companies that funded that, they can't just unlimited, just keep putting money out. They have to get some of their money back to then go originate another mortgage. So what they do is they package up all that cash they've got sitting in people's mortgages, and they turn it into what's called a mortgage-backed security. And either they go sell that on the public market, and you know, hedge funds, pensions, you know, even you and me buying some of those in our brokerage account. But the biggest buyer of those mortgage-backed securities clearly is the federal government. And at the rate at which they're buying that, or even selling those mortgage-backed securities, is another giant lever they have. And again, this is as directly tied to what goes on in our industry as the Fed funds rate, okay? So you look at, basically, this is in the millions of numbers. So if there's $10 trillion out there in the mortgage market, it looks like the federal government alone owns about 27% of all that debt. So they typically, the last several months, have averaged somewhere around $2.6, $2.7 trillion owned by the Federal Reserve, which again, last year, 2021, the federal government from all their sources basically brought in about $4 trillion. And with a lot of the stimulus and surplus and all those sort of things that the government, depending on who's in office, chooses to do, we spent about $7 trillion last year. So that $3 trillion deficit basically could either mean, all right, we went in national debt $3 trillion more, which we keep track of that, but it also is the buttons they push just to go print more money. So we got printing presses of physical cash. They can just turn up the speed and just print more and dump more money into the market, or they can start pulling. You hear the words quantitative easing, quantitative tightening. Kiyosaki is one that talks about this quite a bit. But again, basically since what, January-ish, maybe February-ish, Gordon, will you mute whoever's talking? January-ish, the Federal basically Reserve stopped buying paper, is what Gordon said. So for the last several months, and look what happened to the Fed fund rate. Because again, they'll jump back and forth between those two levers. Basically, when they stop buying paper or those mortgage-backed securities from either Fannie, Freddie, or the other mortgage institutions, they immediately start raising the Fed rate because they moved from one strategy to the next strategy. So even when we were basically zero, they were still dumping money into the market for us to free up capital for lending. Gordon, did you have any other comments on this? I know that's very complex and deep.
That's the other way. And that's the other way that they're doing quantitative easing, is buying these mortgage-backed securities. They started doing it in the 2009 shift, and they just continued on to keep everything low, and really lower than they should have for a really long time.
Yeah. And even when they stopped buying that, right, when they went from 1.7 trillion down to even 1.3 trillion in like a 2-year period, like who's buying that? You know, where do those get sold? It's either the private market. There's a lot of foreign nations that own, you know, some of these. So it's just interesting to see how those pace with the market pace. So any comments or questions on that? Pay attention to what the government does, no doubt. So Gordon, I appreciate you doing this as well. So we're starting to get into the mortgage market predictors. So this is called the MBA. The MBA is the Mortgage Bankers Association. This is the weekly Mortgage Banker Association Purchase Index. It includes all mortgage application for the purchases of a single family home. It covers the entire market, both conventional and government loans and all products. The purchase index has proven to be a reliable indicator of impending home sales. So when we put an under contract or we take a listing, you know, if you look at days on market, basically whatever listings we take, the percent that are selling and the days on market taken into play with that, that's a predictor of our closing and our GCI, right? Under contracts, no doubt, is also a predictor. We look at that as our Keller Williams offices as a big metric for next month's revenue, GCI, what our agents are going to be making. But clearly, mortgage market, they look at applications. And one of the caveats on this is not refinances. We don't have the refinance data. This is simply purchase index. So if we add a refinance data, it would be even crazier of a chart. But you look at where we just ended is basically 160.4 index number. The peak was right there at 2021. We hit 348. So just look, basically almost, 2.5 times, 250% more mortgage applications were coming in at that time period compared to where they are now. But if you actually overlaid the refinance data, that same time period, at one point, a lot of my mortgage partners, they said half their business was coming from refinances. So if you add refinance applications, we could be as high as, 700 of a number. And with how fast refinance is dropping off, we might only add 20, 30, 40 points to the index to add refinances. So it's crazy. We've gone through a swing of closed transactions, but our hearts go out to our mortgage partners because they have seen a lot more drastic. They hit the refis, hit them in the pocket, and now purchases are dropping off. So you've just started to hear about mortgage companies and layoffs, consolidations. They're probably even going to be really careful on splitting expenses with agents and stuff like that. So understanding things from their perspective could help you, have those great partnerships with them. So anything else on this, Gordon? I know this is another new one that we've got. Nope. Okay. Jordan, anything on mortgages? Okay. So this is mortgage credit availability index. Again, this is another one of those indexes. This is basically just how much mortgage credit is available in the marketplace at any given moment. 100 is just that really healthy, balanced ratio. Immediately coming out of the recession, if you saw some of those, we were really below that 100 number. Clearly 2017, 2018, 2019, the amount of mortgage credit available was just at all-time highs. No doubt we've kind of trickled down a little bit, whether that's, them just not actually having enough capital to do the loans, maybe regulations trickled up a little bit, whatnot. But even if we pulled that now, I think we've probably even gone down a little bit, right? So here's your month to month. We ended September basically at that normal 100 index. We were at 103 at the end of September. So interesting. And here's just kind of the different loan products and their indexes tied to it. Which again, Jumbo, look at Jumbo. Jumbo, right when COVID hit, Jumbo just stopped, right? Just like Jumbo just really dropped pretty quick on the number of applications. So this is another great one. So a part of it is we know that rates have gotten drastically worse. It's hard to find an investment that you could even remotely cash flow right now because rates are just really cutting into the cash flow. Rents have gone up a little bit, but this is out of all the loans in the country. Gordon, what did I say? So out of there's 120 million single family houses in the country. 120 million. Wow. What percent do you think of those 120 million are paid off? This stat shocked me.
That one shocked me when we were talking yesterday.
40% of all 40% of all those 120 million households actually have paid off free and clear houses. Which again, when you look at demographics, you probably heard about the baby boomer generation is sitting on $12 trillion of assets that one way or another is going to be inherited by the younger generations and primarily supposedly the millennial generation. Somehow I don't have that family tree. I was hoping I'd get my fair share, but I don't. But again, out of the other 60% of the 120 million households, what is their current mortgage rate? And if you look at this, because there's a lot of people that have just hunkered down because they have such a great rate, and their lack of motivation to go sell or buy or whatever is because they have a great rate in their home now. So they're willing to just wait and watch. But 99% of outstanding mortgages have interest rates right now below current market rates. But even look at, you add up these numbers, 3% or below. So you got 20, 32, 41% of mortgages outstanding right now have an interest rate at 3 or lower percent. crazy, right? And then you can kind of see the other, but even just 4% and below is what, maybe 65%, 70% of all mortgages or more. So still very healthy. And I know there's some challenges on loan assumptions, but again, loan assumptions, seller financing, I know a lot of you are looking back into learning about those and mastering those. Those no doubt could be very great options for us to navigate the next little bit of the market. Here is US affordability. This is across the nation. You see even the lower the number, the worse it is, right, Gordon?
That's correct.
So we're at 16 at 2021, but again, here's 2022 US affordability projections based on an index. So the 100 again is healthy. Above that, homes are a little bit more affordable than average, but then it just keeps dropping. So here's the month to month. This is the monthly housing affordability index. A higher HAI ratio indicates relatively more affordability. A ratio of 100 indicates that the median family income is just sufficient to purchase the median price home. So we've been hunkered down there for at least 6 months, which the rates killed us on that. So it's just the word is just sufficient to purchase the median price home. And Utah gets slightly worse. So same calculation with that 100 index, we're already below that because prices have gone up faster in Utah than around the country. Our affordability has been negatively impacted worse than around the country. We ended last month, again, we've kind of been in this lull of the middle 60s, but we even ended up at 72 on that index scale. So they are not, the median family income is not sufficient to purchase a median price home right now. All right, so we're going to jump into investment properties. We got about 30, 45 minutes, something like that left. Before we jump into some of the investment stuff, we're going to go over average rental rates, rent versus own, US year-over-year rent growth, new build for rent, institutional buyers, that type of stuff. Let me stop sharing my screen for a sec. Is there any quick questions or any points or other things that you guys want to bring up just about the general 5 big things that we track for the housing market? Any other aspiring economists have something they want to add? Going once, twice, okay. Again, thank you for being on this and paying attention. All 150 of you are rock stars. This is something you have to be paying attention to. So again, those are, if you have to stop at a point when you look at our market report every quarter, that's where you should stop. We're going to go through some investment stuff. We do have a little bit of commercial and luxury categories that we keep building out. We have a construction category we keep building out, but we're going to keep adding to that. But if your brain's already in burnout mode and you've exhausted your ability to retain some information, just plug your ears or just that's where you'd stop. But let's at least jump in. A lot of our buyers, no doubt we've got a chunk of people that just represent a lot of great investors. I do think overall, I felt like investors are kind of in the majority of them are in a wait and watch period, but no doubt they are licking their chops for all these opportunities to come, and they are ready to start being represented on buying some good assets, right? So let's get you more familiar with the rental and investment market. But here is Utah yearly average rental rates. Here's by county. So 2021, again, Utah County, if you didn't know this, we've had on average a higher average rental rate than the other counties. We're not the cheapskates anymore down here in Utah County. 1301, which could be a little bit more of the lack of inventory down here, more demand for housing. We're supposed to be adding 1 million people in Utah County, so I think that's putting a little bit more pressure on prices.
Yeah, that 1301 is actually Salt Lake County, and the gray is above that, which
so they got to be like 1375-ish, something like that.
Something like that, yeah.
Thank you. And then here, just Salt Lake City. So he found a report that actually breaks down the different unit types, but this is just the Salt Lake City area that we can only find the most accurate data. We have some other sources, but we haven't verified it enough that we're not ready to present it to you. But a 4-bed here in Salt Lake City average is year to date somewhere around 2,400, 3-bedroom 2,100, 2-bedroom 1,566. 1-bedroom 1,270, and then a studio where you're sleeping on your couch or whatever. Here's 1,149. which the amount of construction going on in downtown Salt Lake, no doubt is crazy. You're seeing a lot of those studios and even more inventory of 1-bedrooms popping up. So here's 2023 fair market rent set by HUD for federal housing assistance. So Gordon, they have to have, because there's several programs in the federal government where they grant housing assistance. There's some do with, foreign and refugee status. There's some of just low income. There's a lot of other programs out there, but basically the Department of HUD has to have some sort of metric that they track to give them the information on what they're actually going to contribute to in those housing assistance programs. So here's basically all the counties, the fair market rent set, they set up for the year in advance. So here's 2023, like Salt Lake County, they've set the standard at 2308, 3 bedrooms, 2061, 1504, 1258. And again, most likely, sometimes the market rate is going to be a little bit higher than that because the HUD, no doubt, tries to try to get a really conservative baseline.
Well, and the other challenge is they're basing it on the last 5 years of data, so they're behind the times as well. This year, HUD actually allowed counties to determine if they could pay 10% more just to keep up than this actual price that they've set.
Yeah, and with the speed at which things change, it could potentially make things more inaccurate. I know the thresholds of the loan limits on a lot of loan programs, we've somewhat been frustrated with because they felt a little lower than other markets comparable to us in a lot of ways. But again, they just end up being a little bit behind. So here's, they did this at Mega Camp. So Gary, our research team, Jay Pampazan went through this. The renting versus owning debate. They actually went and hard calculated every bit of, what is the difference between owning and renting and investing the last 10 years. So basically, if you bought a home in 2012 until 2021, if you owned it, this is a median price. And in the metric of owning, they put all the costs. Like, it's not just about the principal and interest payment, but no doubt whoever owns a home usually bears the responsibility of maintenance. When you acquire a home, they took into calculation closing costs and some of the fees and stuff like that you've got to pay. So basically, after 10 years of owning a median home across the country, after 10 years, you would end up with $206,000 of equity. Okay, after all those costs are brought in. Now the debate is, if you went out and rented at a median rent price, across the country, there's two options. If you were just so diligent that instead of when you rent, any extra money that you normally would have contributed to owning, you actually invested that just into an S&P 500, growing at 8, 10, 12% the last 10 years. If you invested 100% of whatever the remainder is that would normally have gone to owning, if you just poured that into investing it, even at what the financial markets have done, you would only have about $124,000 of basically net worth after that 10-year period. And even a more realistic number is basically if you rented and then saved 10% of the difference of owning instead of all of it, if you were not as diligent as that middle column would be, you would only have 79,000. And again, if you're going to just try to, have a very short-term perspective, 1, 2, 3 years even, there might be a little evidence that says renting would be less affordable than owning. But again, over any sort of long-term period, 5, 7, especially 10 years, owning real estate, regardless of ups and downs, will always tend to pay out a higher net worth, right? Even now, because we know our renters are not saving that money, it keeps going up, but the average net worth of a homeowner versus the average net worth of a renter, the gap just keeps getting bigger, and it's crazy the difference between those two categories. So no doubt, even just showing some of these stats and data when you're talking with buyers, because I even have buyers talking to me that says, what would you do? We want to go move into a house, we want to buy a house or whatever. I'm like, do you plan on being there for a little bit? Of course, they're normally going to say yes if it's owner occupied. Owning will always be a great long-term investment. Rent to income percentages. Here's rent to income percentages. So basically, out of the median income a single like a one person's median income paying the medium rent for that right now, Salt Lake City in 2022 is saying 36.4% of your total income is going to pay the median rent price. Correct, Gordon? And then even Provo and Orem, again, which is worse, whether we make a little less in Utah County or the rent's a little bit higher, but again, we're at 43%. We're closing in on half of your income could directly go to a rent payment. And if you're not investing, again, that's where you can wake up 5 years later and have nothing to show for it. Anything you want to say on this, Gordon?
Sorry, it was mute. And back to that other slide, the Provo Orem area, their rents have increased even above Salt Lake County for the first time ever. Yeah. And that's why the income percentage is so far off.
Do you know if the income is lower in Utah County than Salt Lake County?
It's higher.
It is higher. Okay, but just rents outpace it so much that that's what that number made worse.
Yeah.
Okay.
Yeah, because of the Silicon Slopes.
Okay. Anything on this?
I just kind of wanted to show how much low-income housing we were short in the state of Utah. You know, what we're building is not entry level. Even the apartments. I mean, when was the last time you saw a 2-1 being built for an apartment? It's just not happening.
So this is saying that right now, 2022 housing profile, we are 40,981 rental homes in the affordable or extremely low income renter category. Basically 41,000 homes short that we're missing in that affordable rental market, correct?
Correct.
Okay. And again, that's where there's a lot of, studies and research and universities trying to tackle that affordability. How do we, who's impacting that the most? How do we bring supply costs, labor costs, even the service fees of title mortgage and, all of that is being looked at right now. And how do we go back to that? Again, coming into this recession, no doubt a lot of the money we've dumped into the market helped us get out of COVID quickly, but it felt like we were overstimulated, which has caused some of the inflation problems that we're in. But again, even in the time period that we're going to be in the next 12, 18 months, the government's going to have to step in to create some tax credits, some programs, homebuyer grants and stuff like that, just for us to figure out how to solve that, affordability issues, right? Here is the rent growth year over year percent. So this is looking at last year compared to this year. You see most of the late 2021s, early 2022s, year over year growth. We were sitting at that 17%. Our property managers were scrambling, renters were filling that, in their pocketbook, but rent jumped up on average 17% in 1 year across the United States. But it's kind of trickled down as, some things have slowed. Doesn't necessarily mean that rent has gone down, but it just stopped growing at such high speed. So even this means that we grew 7.6% rent on average in the country compared to last September, which the September before we were up 15%, which I know there's a possibility that rent could go down in a recession, but it is hard to see how that's going to come into play because of the lack of housing, how expensive it is for investors to buy these rental properties. And again, typically all costs get passed on to the renter to make sure that, it's a viable investment. Because if that doesn't happen, investors will just stop investing into real estate if they can't make money on it or get an ROI on it. But we've got to, I don't know how we're going to figure that out. Again, I've said it several times, but rent is still projected to go up the next couple of years, no doubt. U.S. new build for rent, 2 or more units completed. Oops. So here is 3.7. Explain this to us. It's basically 3.7 million new build units completed. Is that what they're saying?
And the 47-year average is 3.65. So we've had 31 years below the 47-year average. So that's why we're still under building. And what we're building again is not the lower end. So that's why a lot of people don't think that the rents are going to struggle that much during this next recession.
Yeah.
And people can't afford the house payment when you add $800 a month onto it. So they're renters.
Yeah.
So it contracts the supply even more.
It's been, the multifamily, the apartment complex, like it's almost every city. There's just been huge apartment complex going up. I know that's been the buzz. Everybody's talked about it. You got people like Grant Cardone, 10x cash flow, like he's been all about that. But I thought we were going to get a tipping point that we've just built so many apartments, but clearly the data shows. I read a CoStar study 2 weeks ago that even the latest CoStar, which is like the commercial MLS, like it's this huge company. If you don't know anything about CoStar, a lot of commercial data, they still are projecting that we might even just be 4 million apartment units for rent short just in that category alone. Institutional buyers. So this is from all of 2021. We probably won't have 2022 data, but basically out of all the homes purchased, what percent of those in each state were bought by institutional buyers? So you see Utah, 16% of all homes bought in 2021 were bought by institutional buyers. If you don't know what an institutional buyer is, it's basically like a big capital group. Like it's either like a VC fund, one of those big Wall Street funds or something. It's basically just a lot of money's poured in, a lot of partners, that type of thing, going out and buying houses, typically to rent. So again, looks like Texas was the highest in 2021, 28%, over a quarter of their entire market bought up by institutional investors. And again, the more live this data can get, this is an NAR report, so we should have 2022's data early 2023. So we'll see how fast this has actually changed. But again, what does institutional investor groups want? They want to make appreciation, they want to make cash flow. Like they've got to have a big return for how many investors they've got in it. So even if you had an investment strategy, the more live this data can be, just even following around where these guys are going or these groups are going, probably is a good investment strategy. But it's just crazy the millions and millions of homes bought from institutional buyers the last several years. Even Hawaii, Alaska is one of the lowest one, if not the lowest. Oh, Vermont, 0%. Who wants to buy in Vermont? Just kidding. If you're from
I think it's also important to remember that those institutional buyers are usually buying, that's inventory that won't come back to the market in the next 3 to 5 years. So in Utah, 16% of the market essentially just disappeared. In Texas, 28%.
Yeah. Yep. Which again, this is an opportunity. So like values start going down, cash flow starts tightening up, no doubt they would be more motivated to move their capital from, single family homes to other asset sources, bonds or whatever. So I do think this is a potential thing we've got to watch, because if they start dumping a lot of their owned inventory onto the market, it could send, some data out of whack pretty fast, right? Another one I know you guys are probably paying attention to, but is even Airbnbs. I've read a lot of reports the last several weeks that a lot of Airbnb communities or owners are seeing pretty rapid declines in their bookings. Which there could be a chunk of these nightly rentals that all of a sudden get either dumped back onto inventory for sale, or they all turn to, long-term renters, which could be a little bit of reprieve for that renter, rent pricing and whatnot. So rental vacancy, here's a number. When you're calculating your rental analysis to buy a rental, I've used 7-8% for a long time, but clearly it's an outdated number. Utah, in 2008 to 2013-ish, we averaged around that 7%, maybe 8%. But for the last 7 years, we've been trending in that 5%-ish on average. Last year, we were at 4.4%. My guess would be we're still somewhere around that for 2022. So when you're running your numbers, you still might want to use a 5 or 6% vacancy rate just so you're planning for the future. But the balanced number is 7% vacancy, 7% vacancy. Okay. Gordon, Jordan, anything on investment properties before we move on?
No, it's just going to be a really good time to watch. I think there's going to be some really good deals to either wrap the loans. Some of those properties are paid off and they want to retire and get out of it. And you could do a seller finance, give them a couple extra percentage points, get a 4.5% loan, and you can still cash flow.
Yeah, yeah. So, a couple of the biggest challenges we have is the sides per agent. We're going to see a lot of the bottom of our industry be at risk. I read a report a couple of weeks ago. I think the number, Gordon, was 400,000. Like NAR projects that potentially we could lose 400,000 of the 1.7 million around the country. But again, when you look at half of our industry that doesn't close a transaction, there's still some room to free up some of those deals for our people. But, part-time realtors could be somewhat of a challenge. It's time to step up and get on your game. But again, you've got to make sure you're decreasing your personal household expenses so you're not creating a deficit in your own life and limiting your opportunities of any cash, equity, or whatever that you have to then just go multiply. A lot of, even locally, we talk a lot about just investing. A lot of us just wish that net worth and income would grow like this, but Gary's very clear that it is a stair stepper, right? And we're in a phase where preservation of wealth, decrease in consumption, decrease in lifestyle, like just really protecting your household profit and loss statement, because we're seeing some good deals already. But you're right, Gordon. I think 6 months from now, 12 months from now, I know you all are probably licking your chops on the deals that are going to come about, and just do not ruin your opportunities and your chances by making bad decisions the next 6 months. Because there is more millionaires made coming out of a recession than any other time period consistently.
And in an inflationary position.
Yep. So let's talk about the federal economy. Okay, the U.S. economy, GDP, unemployment, real wages, income by sector, inflation. We'll touch on some of these real quick, just to see what's going on. And again, the rumor in the world or on the planet is our Federal Reserve's being a little bit more aggressive, no doubt, than other Federal Reserves. That's why you've even see that currency exchange play into our favor. I don't know if you've traveled lately, but a lot of our dollar gets a little bit more bang for our buck pretty much everywhere right now, because hopefully we are being a little bit more aggressive. We're hopefully solving our problems, so potentially we could get out of whatever's going on a little bit faster, right? But no doubt our economy in general, there's several things to watch. GDP is one of them. You look at COVID year dropped, we rebounded quickly. Projected was we were going to end at 0.2% overall growth for the whole year. I don't believe that, Gordon. We don't believe that. If you look at Q1 alone, we were down 1.6% GDP, which it seems like a tiny little number, but we're talking about gross domestic product, which is the accumulation of all products and services, trillions of dollars that our federal government, all businesses, everybody here. So when it drops 1.6%, we're talking about millions of dollars. So down 1.6, down 0.6% in Q2. Q3 did not come out in time for this, but I don't know how it's not a negative number. Do you agree with that, Gordon?
Yeah, I've been watching some of the news articles over the last couple of days, and it's a real swing. Everybody keeps saying, "Oh, it's going to be above one. It's going to be above 1%," and I can't see how that's possible with the core inflation so high. Yep,
no doubt. U.S. unemployment overall still really healthy. We ended last year at 5.3, but on a month-to-month basis, again, COVID, it did feel like almost every restaurant, every shop, if you were on the bad side of COVID, movie theaters, all that sort of stuff, it was miserable, that whole K economy. Luckily, for our industry's benefit, real estate just exploded. We crushed it. Like, it was sad to see other industries that were getting hammered by it. But again, mortgage rates, we're on the really bad side of this federal change, right? Like mortgage rates, Fed rates, mortgage-backed securities, it affects us faster and bigger than any other industry too. So we're kind of balancing out from what we experienced in COVID, but we ended September at 3.5 months of unemployment, which is crazy. We still have such a healthy job market, which is one of the biggest advantages that we have. We've heard about unemployment, we've heard about layoffs, that type of thing. And I always make this point because I learned this in my my macroeconomics class in my schooling, but the baseline always is going to be somewhere around 5%. There's always going to be 5% of able working people that could have a job that just currently don't. They might be in between, they might be moving, states or something, but there's also just a small little chunk that probably should just never have a job, most likely, or never hire. So when we get below 5, down to 3.5%, there's definitely some businesses taking some chance on people, no doubt. Here is, U.S. unemployment job openings. We're still, which is crazy, last month, August, actually, because we don't have September's numbers yet. This is one of the lag reports. There is 10 million open jobs across the country at the end of August. I do not think we sustain that number. If anything, we've no doubt fallen, but that's the number to watch too, because as soon as that tightens up, that's when you start seeing unemployment number go up. As soon as the job openings go down, more people being out of work is likely. So we even start getting into the 4s, the 5s, the 6 million job openings. You'll start most likely seeing the unemployment trickle up.
The other challenge is we've had a whole generation basically peak out over the last couple of years. So, you know, we're losing a lot of people that have that experience in the market. And my generation, Gen X, can't replace them. We're too small.
So you're saying people that just chose not to go back to work?
Yeah.
Yeah. Yeah. I can't remember what that number was. The early retirements when COVID happened, instead of them just dealing with it and all the struggles we went through, they're just like, I think I'm done working. Which
Yeah. The younger boomers that planned well, they're just like, yeah, I'm not going back to work.
Yeah. It's the dang Gen Zs that's screwing up society. Just kidding. Just kidding.
The Zoomers.
Here's this is called the real unemployment rate, or U6. It includes underemployed, marginally attached, or discouraged workers. So this is people that either are underemployed, that they want more work, or maybe they're just not getting enough hours, or they could actually go employ more. Marginally attached may just be that they're at risk, or that whole great resignation concept, or even just discouraged workers. That would have to be highly discouraged workers most likely to hit this. And a lot of that is, this ends up being a little bit of survey based. But again, you see U6 unemployment, we're actually probably more at 9.4%. So add another 6% of society that is either underemployed or just, completely discouraged. Jordan, are you discouraged? Are you part of that stat? No?
No, sir.
Okay. You're encouraged. You're part of the other percent. I like it. Here's the real unemployment on a month-to-month basis. So again, it was really bad after COVID, but we ended the last several months around that 6.77% actual. That includes that discouraged or underemployed. Here's real wages. Incomes on average in the city of Utah and in the US went up, but so did all of the expense. So this takes into play inflation. Inflation, no doubt, has been the number one news headline when it comes to the markets the last year. But when you take inflation in to the increases in wages that we've experienced as we've been more productive the last couple of years, we actually went backwards last year because it got wiped out. Any pay increases, I know a lot of people might have felt like that, but it was the reality that the real wage year over year actually dropped. You could buy less. And again, we don't have the full year 2022, but here is the month-to-month real average hourly earnings. So a lot of negatives at the beginning of the year. I don't know what happened in July, but then again, last month we dropped 0.1%. So once we get the 2022 number, you add all those up, we could be at maybe 2-3% drop, Gordon, on actual real wage decrease.
Yeah. It depends on how much the core inflation goes up too,
which is the hot topic. That's where Gordon gets animated, because we feel like there's a little bit of craziness going on. But here's income sector, year over year percent growth, and then January 2022 wages. So you can kind of see some of the industries that are better off than others. Clearly financial activities, professional business services, wholesale trade, a lot of those clearly had higher wage growth than others. Here is inflation. So let's talk about inflation. Gordon, why did inflation happen? I think clearly we've talked about it the last couple of reports, but it was a little bit of the perfect storm that kind of happened. COVID crushed us in a lot of ways, which primarily was the supply chain. The picture of hundreds of those ships stranded off the California coast, not being able to even unload their goods, concepts like that, the manufacturing facilities, the strictness of some of the foreign COVID policies, even above what we experienced, just totally shutting down factories. Like, when supply goes down, naturally demand goes up, so even if nothing else happened and we could have just simply recovered the supply and the supply chain issues, it could have helped demand come down, which could have helped us a little bit on this. We no doubt were headed before COVID happened. We were headed for a recession, and so COVID happened, which immediately made it all worse. But it basically gave us some reasons to be able to pump some money in, and even actually COVID prevented a recession at that time period. And again, the Fed, either them pumping stuff in or trying to pull out. The comparison is always they're trying to land an airplane perfectly, and they just never really get it right. And they dumped so much money into the economy that just by nature, more capital being into the market, just naturally, whether the companies, real estate's doing good or not, there's just more money. So it just makes values go up. So even there was just a little bit of fictitious stock market rising, on their valuations, real estate market can be impacted, that type of stuff. So even them pulling market capital out can hurt us for sure. The war, Russia, the whole energy crisis going on, the OPEC, lowering their oil production. Energy's had a huge impact with us, but the CPI, the two big numbers they track is, the consumer price index is what CPI means. Yellow includes energy and food. So food's gone up, but energy overall has gone up worse. So that's why you see that CPI that includes energy and food being a higher number. And that's where core CPI, which excludes energy and food, because those categories can be a little less sustainable, a little bit more volatile up and down on a month or quarter basis. You could even see that being at 5.5%. But everything we're seeing, all the work that we are trying to do to curve and get that back down, it's clearly showing a lot of the projections are that we might not get it back to the sustainable 2% level until 2024. That's why everybody now is kind of saying 2023 might be a little bit of a recession marketplace all of next year. Any comments on that, Gordon?
Nope.
And then here's inflation monthly, which again, on a monthly basis, we went up. So that core with energy and food, we peaked at 9.1%. Even the one that excludes energy and food, which is what the concern was the last couple of times that number came out, is we're still going up. We're still going up. We haven't turned that around. I know even, the administration opening up some more oil reserves and stuff. They're trying to impact the energy one to get it down, which might have been some of these. But the fact is, what we're doing isn't having a dramatic positive effect because the challenges just take time.
Yeah, and the core and PCE are the two things that the Fed really looks at to see if they're going to continue raising rates. And until we get core under control and PCE start growing again, I think they're going to continue like 75, 75, 50. They're going to take a deep breath. If core has not leveled out, they're going to keep going until they get the Fed funds rate above headline, which is 8.2 right now.
Yep, totally agree. And here's even some of the categories of increases you see. And this is why, like fuel and oil, this is basically a 12-month% change. Like fuel and oil is up 58%. You guys know that. Food, food feels a little worse than this, to be honest. Like, I don't know if these are just a little cushioned or something, but it feels like food's a little bit more expensive. But on average, it seems like 10, 12%. Even natural gas is up. But look, when you actually, if you were to truly add the growth and the lack of affordability in the real estate market when it comes to true, real home payment increases, here's interest rate increase, it's 115%. And that's where Gordon and I still feel like if they actually included all this, our inflation numbers probably been drastically worse the last year. And that's why, that number they put out just might be a little bit of marketed cushion or something in there. So here's flexible and sticky CPI 12-month change. Gordon, explain this one real quick. What is sticky versus flexible?
So the flexible, I can't remember what the flexible is, but the sticky is what the Fed feels like is going to stick around and it's not going away. So, those prices that you're seeing in the store, they're generally not going to come down for core services.
Yeah, what they have the most control over clearly is thrown into flexible. So like if they just open oil reserves and dramatically swing down the cost of fuel or something, clearly that is a metric they have more control over. Sticky is just, it's a little bit more, it is what it is. And so the underlying less manipulative, CPI pieces of that is still trending up where, even the ones that we can make decisions on and change is impacting us, but we've got to turn and get that more sustainable, no doubt.
And these are Fed numbers, and realistically, the flexible number is probably really where we're at as far as core inflation. We're really in double digits.
Yeah, the one thing I was talking to you, Gordon, about, which again, this is my opinion coming into this market report, but anybody that's seen that the Big Short video where what's the guy's name, Burr, he predicts kind of that. He goes to these big banks and he gets them to create the product that shorts the mortgage market. There's like at least a half an hour that is in that movie that shows the frustration of him, because he knows it's going down, but yet there's so much of the government, entities that just are delaying it, or even puffing it up, or even back then straight out lying about it, which just actually delayed the reality of what we're in. I just think there still is a little bit of that going on in our government, no doubt, of just, we haven't got the whole story, because it'd probably be worse. And they're trying to probably solve some things before they allow some of that data to be rolled up. Do you agree with that, Gordon?
Oh, yeah.
Not that we're conspiracy theorists, but here's producer price index. So basically this is manufacturers. So this is basically their index and kind of the outlook on manufacturing and the demand for us creating products, which this is, still very positive. There's still a very high demand of producer price index. Here is the real personal consumption expenditures. This is just how much stuff we're consuming. So even though, Q2 2022, our GDP went down, we start seeing some of the bad signs, we still are slow to learn, and we're still spending money. People are still going on vacations, buying new cars and stuff like that, which this is a bad one. Americans love consumer debt. We're at an all-time high. We just came out of the best market ever. The last 10 years on stock market, equity gain, all that sort of thing. It's been a great time to make some money, yet we're running at $1.1 trillion of consumer debt. This is not mortgage debt. Long-term, this is consumer debt, revolving consumer debt. Annual personal savings rate. So this is basically the rate of disposable income, how much we're saving. So we are dropping. No doubt COVID freaked everybody out. They just stopped buying stuff and they just start saving like crazy, whether it's by force or by choice. But we're already back down to 3.5% of our disposable incomes getting saved. We talked about this yesterday, Gordon, but because disposable income has shrank, I think, and we're just not, we're not being as diligent with our expense management. Everybody's talking about it, but they're not doing it yet. We need to be.
Well, they don't really see what's going on right now. We're at a lag of 6 months.
Yep. This is another good one, which is a pre-indicator of manufacturing durable goods. So this is new orders in the millions of manufacturers. So this is even just forecasting all these retailers, what they're ordering from all the manufacturers, and it's still a positive sign. We've been going up the whole last year on orders for that. So either retail, people actually selling us the stuff are actually accurately projecting the demand of consumer goods. B, they're catching up on their supply chain a little bit, or they're miscalculating it and they're going to end up with a bunch of inventory, right? And this is also, we're right by the holidays, which usually jumps up right before the holidays anyways. ISM, what's ISM again, Gordon?
I can't remember what ISM, but this is the Purchasing Managers Index. And what this really, the purchasing managers watch this like a hawk because they don't want their inventory levels to be sitting. So when they see things start contracting below that 50, they stop ordering.
Yeah, when you're in a product creation business, like inventory is probably the number one reason that a business can go out of business, right? Just because if they don't manage their inventory the right way, they could end up with warehouses of stuff that's not going to get bought. And then here's just another one, an advanced retail sales percentage change. Again, that's positive, up 7.8%. This is U.S. Index of Consumer Sentiment. So this is a little bit more of a surveyed base, but this is just asking all consumers how they feel about that. This is an index. We've actually gone up the last couple months, but we're still right around that 58, which is the lowest consumer sentiment on average we've had the last 10 years, which makes sense. And then here's the misery index. This is a one that kind of brings into inflation and unemployment. The lower the index, the better. Right after COVID, we were the most miserable with unemployment. Inflation immediately dropped, but you see we've actually trickled back up to recession misery kind of numbers.
2008.
And it's definitely gone down a little bit more on a month-to-month base. And again, here's inflation. So this is 1989, what those things cost. Here's 2022 on average, what those things cost. What is the real change from 1989? So no doubt a car based on income levels is 31% more expensive for us in comparison with all those numbers adjusted. Gas drastically more expensive, 66%. The price of homes is drastically up. But again, when you compare us to 1989, because rates were still a little worse for sure, and rates have such an impact on affordability, we're still cheaper on our mortgage when this was created just off September. And then again, wages are up 19%. So again, I think wages overall are a little bit better. I think there's just more stuff that we have to buy, which lowers that. And those are just these are updated, right? We don't have the updated ones yet.
Up through August on a lot of them.
Okay. So here is, some of the numbers, August, job change by industry, which industries are growing, which ones aren't. Non-farm employment, 2020, we had a lot of unemployment, obviously with COVID, but we've been pretty great. We're still very positive. Anything outside of farms is growing still substantially. Our unemployment's 2.7% last year. But right now we're at 2.1%. Here's the nation in that purple. We are underperforming, outperforming, but we're lower than the nation unemployment percent, 2.1%, which is crazy. Skip some of those. That's from 2021. Here's Utah real GDP. More people in general here helps, but our GDP has just been growing. So all-time highs last year. We'll still probably have a great number this year. Real GDP year over year change, our economy just keeps growing, specifically here in the state of Utah. Even 2020, when the nation dropped overall that year, we still grew GDP throughout COVID. So we kind of handled economically COVID a lot better. Here's personal income. I actually assumed that Utah would outpace the United States a little bit higher, actually. Some people think United States wage increase has been higher, but for the most part, the last several quarters, the last several years, Utah's outpaced the United States on personal income growth. But if you look at least the last year, we're pretty spot on with what the nation's doing as income growth as well. So
and see, this one surprised me. I didn't think that we were outpacing the rest of the United States. I thought we were always lower, just like home price.
But Gordon, we're smarter, we're sexier, we're cooler. Like, of course, we're going to make more money. Just kidding. And then let's try and hit construction, and then we'll zip through this. So again, here's just the lack of inventory. We need to be building 1 million every one of these years, 400 short, 600 short, 600 short, 600 short, 500 short, 400 short, like hundreds of thousands per year accumulated, no doubt, to that potential 4 or 5 million homes underbuilt. Utah residential housing starts by month. So this is comparing builder permits pulled and then units completed in the dark purple. Normally they kind of correspond a little bit, but we actually have more units being completed right now on average than we have builder permits. That gap's widening, which potentially could show us a little bit of a challenge of we need more builder permits. We need more housing starts, right, Gordon?
Yeah, well, and it also shows what the new entry-level home is. It's not a home. The standard Ochre Shadows blocks are not being built. Now they're being built into condos, and that increases the number of units per building permit.
Yeah, what did we talk about yesterday? Because again, rates gave us a little bit of a deception, right? If we averaged 6% the last 30 years, 8% the last 50 years, like the cost of homes just keep going up. Labor costs, supply costs, land costs, municipality fees and stuff like that. But because we were living in such low interest rates for so long, we never truly felt that like increase in just the overall cost of housing. Like it became just a gift for us, no doubt, but it helped us lose reality of what the true cost was. And so now that rates are even going up to actually more sustainable average levels the last 30 to 50 years, it is just slapping us in the face because we haven't been able to systematically adjust to those costs, right? So again, that's what's creating the challenge of even a lack of builder permits pulled, because developers, builders, like they're struggling just like everybody else is to how do we build something, make a little bit of money and still sell it for market value, right?
And you really look, I mean, before 2006-7, look at that gap. Go to the next one. The next slide. So look at this gap between
This one?
no, then yeah, that one right there. The gap between building permits and units before 2007. We were building a lot more homes. The homes were smaller. They weren't building McMansions on a large scale. And then after 2008, we just basically stopped building. And the affordable homes that they are building, they're condos now.
Is that a McMansion, like a McDonald's mansion?
Yeah.
Yeah, and part of we mentioned this last time, but there's a lot of big builders that are actually trying to accumulate supplies before they even start construction. So I think that's
Right.
decreasing the time, because the unpredictability when lumber just skyrockets and doubles overnight or whatever, they want to be able to stick to their costs. So I think that's caused us to slow the actual units. Builder permits too.
Well, and they're not doing what they did in 2008, where these tracts of land where they're building them all at once. They're building pieces.
Yeah.
So right now you're seeing a lot of the builders that, laid the slab and they're going, okay, let's get rid of what we've got right now and see where we're at.
Yeah. Here's just the volume, billions, 8.8 trillion of housing starts basically last year. U.S. price index of family homes under construction, 100 index based on kinds of houses sold in 2005. So we've just, no doubt been outpacing that. Here's even multifamily index. There's been a lot of multifamily construction. Some of those complexes are getting really cool. So I think it's been advantageous. Here's builder confidence index. So this is where the builders go off of just kind of their, overall feeling of the confidence of the market. Right when COVID happened, they dropped to 30, which is virtually those recession numbers. Last month, we're below 50. We're at 46 confidence level index. We should be, 100's kind of really the max of that. Year over year percent, we dropped 20% in that confidence so far this year compared to last year. And that's it. So these are actually only updated once a year. We threw these in. These all primarily come from the NAR reports that come out once a year, like sites per agent, underwater homes, credit conditions, some of those other categories. So we left a lot of those in there, even though the data only goes to the end of 2021. Same with luxury. There's some if you target the luxury market, there's some cool categories to understand and even try to find some other data sources. We're also open. If you find very valid data sources around the country, we're happy to throw some of these on. But our next task on this market report to build out luxury and the commercial sector is a lot more. And then we also throw in these first-time home buyer surveys, the first-time seller surveys, like where do I get my agent? How, what likelihood am I to use my agent again? Those type of questions. So awesome. Thank you, 112 people, for hanging in there. Hopefully you guys didn't fall asleep, but very valuable data. Again, we will do this every quarter. This is being recorded. Gordon, where will the YouTube video be posted?
kwutah.tv, which is our YouTube channel, and I'll also post it on our Facebook pages.
Great. And the market report, like I said, go to kwutah.com, click on resources. In that agent resources, you can download the PDF of this. But Gordon, if you registered, already sent this.
No, I haven't sent it yet. I'll be sending it out later today and uploading it.
Cool.
With the recording.
Well, that's all I have. You're welcome to jump off, but if anybody has any real urgent questions, you're welcome to throw them out. Otherwise, thank you for joining us. Have a fantastic week. You guys are rock stars. Pay attention to the market and let's go crush it.